Hello, and welcome to our August 2026 Outlook and Positioning video. My name is Derek Varner. I'm joined by my colleague Martin Wildy. Hello, Martin. How are you?
Hi, Derek. Good to see you. Good. Thanks everybody for joining us.
So, we're going to cover what happened in the month of July. So, let's first start with performance. We've had good returns from markets in general throughout the year. We saw some divergence in the month of July, predominantly driven by a few factors that have largely driven the markets all year. So, things like the Iran war, interest rates and inflation, and Fed activity, corporate earnings, and then the sort of continued progress of hyperscalers in artificial intelligence, or those firms that are really spending a lot of their free cash flow to build out artificial intelligence infrastructure and data centers. So far in the month of July, stocks and bonds were generally flat, maybe down slightly, but we saw value-oriented stocks and foreign stocks do better, tend to be more economically sensitive, and we've seen an acceleration in, or the potential for an acceleration in economic growth. And then tech stocks, while we saw a lot of dispersion through earnings season in late July, tech stocks were generally down in the month. Martin, what are your thoughts on performance in the month of July and so far this year?
Yeah, I'd say this year we entered the year talking about how we anticipate maybe seeing a broadening out of market performance and maybe not just solely relying on the Mag 7 to lead the way. And I think we've seen that throughout the year. And more recently, we have seen other parts of the market, as you've listed, starting to do a lot better dividend paying stocks, small cap stocks, really contributing more to total returns.
Yeah, so part of that is driven by an acceleration, as we said, in economic growth. So here we measure the manufacturing and services PMI. So anything above 50 is generally considered to be expansionary. So you see more recently in 2026, we've been solidly above 50, particularly in manufacturing, which was in decline for several years. So we believe this is largely driven by, again, the spending from artificial intelligence infrastructure that's been largely funded by the largest companies in the S&P 500, Amazon, Alphabet, Meta, etc. What's been encouraging, though, is, as Martin said, across not just technology and communications companies, we've seen earnings surprise be very, very strong. So companies are outperforming earnings expectations, which has helped drive the market higher all year. And earnings growth has been just very, very robust. Now, we're only about maybe a quarter to a third of the way through earnings season. So we have many more companies to report. But so far, it's been really, really robust and across the board for the most part. Martin, what are your observations on earnings season so far?
Just earnings have been the story this year of the market. And I think when clients are asking, why is the market doing so well this year despite a lot of the other things going on in the background, it's really about corporate earnings. And there's a saying that stock prices follow earnings, and this has been a remarkable stretch of very strong earnings reports.
So that's been positive. On the maybe more challenging side, or the more concerning side, is we are going through a renewed bout of inflation that was sparked by the Iran war. So you'll see here it's predominantly the big uptick in inflation is concentrated in energy. I think we're all aware of that. We see higher prices at the gas pump and in our electricity bills. So this is impacting the calculus of the US Federal Reserve. So the Fed has been trying to cut interest rates for the last few years following elevated inflation after the pandemic. And at this point, they've been on maybe an extended pause in 2026 as inflation has proved difficult to get under control, particularly because of the Iran war. And then you'll see here that the market, which is in green, sort of that 2-year treasury rate, which seeks to sort of anticipate where Fed funds will be over the next 1 to 2 years, is implying that Fed's funds may actually have to go higher to control inflation. Martin, what are your thoughts, or what are you seeing in interest rates and inflation?
Yeah, you can. This is a great chart. You can clearly see the green line moved higher before the Fed started raising rates in the previous cycle, and you can see that unfortunately we're seeing the 2-year move higher again today. Hopefully that gets resolved and moves lower, because that is one of the risk factors to the economy.
So when we look at our dials for the month, we didn't make any significant changes. We're still seeing economic growth be okay, maybe even accelerating to the upside. So maybe we'll change this in the future. The employment situation has been relatively okay. We're below the long-term unemployment rate, but we're seeing new job creations relatively modest. households, we continue to be concerned about household spending and the impact of inflation on household sentiment, which feeds into the financial conditions dial. And we just talked about interest rates potentially even going higher from here, which would potentially have a slowing effect on economic growth, particularly in things like housing and consumer borrowing. But when we look at the market, valuations to us seem okay, mixed. We still see opportunities, and earnings have been very, very, very good. So we're cautiously optimistic when we were thinking about allocating client portfolios. We're not making any big presses into risk, but we're not also de-risking significantly either. We're sticking with clients' long-term strategic allocation and their objectives.
Yeah, thanks, Derek. And I would say as we summarize and wrap up, we think that the biggest thing we're watching is what's going on with inflation and interest rates, and also the spillover effect on spending. If we have higher gas prices for longer, that could start to really impact consumer spending. Thankfully, we haven't seen that yet. And if we still see strong corporate earnings, then that gives us optimism that it's supporting the returns that we've seen thus far in the market. So thanks so much for tuning in. We appreciate the attention, and please reach out with any questions that you may have.
Thank you.